stand right there, you'll be okay.
Okay. Okay, but you can see me like this? Okay. I mean, it's been said that Germans are very serious and committed, or some people believe that, and very disciplined. It's nothing compared to you guys. I mean, you're going full force, you know, like clockwork. Saturday afternoon, 5 o'clock, the sun is shining. No German public civil servant would be in the office at this time. So anyway, congratulations. Thank you for the invitation. I'm going to try to keep it brief. I've been told the conference is multidisciplinary, has the objective to fertilize, cross-fertilize. So as a non-accountant, non-public finance economist, as more a monetary economist, macro modeler. So I'm contributing to that. Although now with Anatol talking about European multi-policy, now I could like talk for an hour about European multi-policy, but I guess I had something else in mind. Namely, you said transparency and accountability, that's how governments build trust and confidence. I couldn't agree more. And I must say, I mean, what I've seen about what improvements are possible in public accounting and the suggestions you have, I found very interesting. And going back to Germany, I'm certainly going to tell my colleagues about it, see what we can do. But from my perspective, I thought I can add two remarks. One on the usefulness of independent councils, giving one example on that, and maybe listening to the talk earlier about, or the different experts and public officials from Greece. There was one issue about a fiscal council. I think it'd be useful to get that started. I'm going to talk about an economic council. The other point I want to make is talking a little bit about how one could actually make the euro area function for the future, just in case it's not already solved. I don't think those are the right solutions, but maybe on that sometime else. Okay, here is a council. This man in the middle is the US president, but you knew that. This is the Council of Economic Advisors. In terms of transparency and all that, great, because, I mean, fact sheets, reports, economic indicators, so that's very useful. One thing which you also note, and that's why I put up this picture, I mean, according to my investigation, the two ladies on the left and right of the president, they're not members of the council. And just in case you didn't know that. So what this shows is it's really also about sending a message, sending the president's message, convincing the public those are the right policies here, laying the foundation for recovery and growth. So there's an advocacy. It's not just advising, it's not just information, it's also advocacy. There are also other councils. So I want to give you an example from Germany. We've taken on board, or we've been by the Allies after World War II, you know, they've created a lot of institutions in Germany, such as the Independent Central Bank. But that's not one of them. That's one which came later. In '63, a federal law about the creation of a Council of Economic Experts by the then Federal Minister of Economic Affairs, Ludwig Erhard. The book he has says Welfare for All, or Wealth for All. He wrote that. Anyway, so he initiated this law. And his boss, Chancellor Konrad Adenauer, so he's the older-looking guy, basically said to him, Erhard, wollen Sie sich eine Laus in Pelz setzen? So I checked, you know, how can I translate that? And in the internet, I found this sentence, Erhard, do you want to put a burr under your saddle? I had never heard that. I don't know. Does that sound familiar to you at all? No, never heard that. So that's the thing. So a better translation, he said, it could be, yeah. So see, you have to be in history, then you know that. But anyway, so another for more day-to-day, he was trying to say, look, Erhard, if you create this independent council, these guys are really going to be a pain in the rear. So maybe that's the same direction. And to give an example, so I'm a member of this council since a few years, and the last 3 years, there's just some titles. So we give an annual report, and here is an example of this annual report. And the titles here, 2013, give a little bit of a picture that it wasn't all, you know, trying to advocate that the policies are right, but there was some criticism, so we chose the title Against a Backward-Looking Economic Policy. In 2014, we advocated more confidence in market processes. We did not mean the German public, we meant the German government. And last year, we said focus on future viability, looking back. So we were not just criticizing, we also were praising the government, both things, but interestingly, the criticism is, I mean, in 2014, after being told more confidence in market processes, the state secretary of one of the parties, the general secretary of one of the parties was in the press the next day, or the same day, and said, these guys have no facts. So, since we talk a lot about facts, so we submit a report with 400 pages. There are some facts in it. But you see, the usefulness is when we're allowed to do that in public, right? So we're formed by a law, and we're allowed to issue our report not just to the government, and then the government gets to look at it, whether they like it or not. At the same time as we hand it over to the government, which you can see at this picture, we can also publish it. And so we give a press conference and all that. So a big element of this process is to have a public debate. And I think you're thinking of, let's get the numbers out, let's give transparency about the numbers, but I think you need, and this came out in some of the presentations by George also, I think, you need also a public debate. You need also experts looking at things, and if, of course, there are many experts, but if there's an institution created by law with some, steadiness, that's useful, I think. Anyway, here's how this works. So there are 5 academics, 5-year rolling appointments. So the government gets to appoint us, but only one person at a time. So it's not everyone appointed by the same government. So that gives a little bit of diversity. Our task is to assess current and future economic development, to aid the public and the institutions in making informed judgments, to examine how to ensure steady growth in the economy while maintaining high employment, price stability, foreign trade equilibrium. So that's a law from the 60s. Whether that's a good target or not is another question. A key sentence here, we were supposed to point out undesirable developments. So that's what we did. We were basically saying, look, if you think about making the economy not just doing well now, but making it sustainable for the long run, what the government is deciding to do, for example, handouts in the pension system, giving early retirement options in an aging society, introducing additional restrictions on the labor market, introducing a minimum wage when you have masses of people coming in who will, in terms of their productivity, not be able to make that minimum wage, and you're going to create more difficulties. Let's give some more weight to market processes. There's a process, right? We have hearings. So this is another usefulness of being founded by law, right? So we actually have a right to have hearings with the government, with government members, with staff of the ministries, with typically the minister, also with unions, trade unions, employer unions. I don't know if we have a right to do it with them, if we can force them, but they're actually very interested in giving their view to us. So in that sense, it's useful. With the Bundesbank and so on. When we submit this report, in January there is a report by the government, which is the government's economic report, which contains some replies. They're always mentioning when they agree on some things. They're not always mentioning when they disagree, only if they think they have a good proof that we were wrong and they were right. But that's normal, right? You wouldn't expect that. And then in spring, we have a meeting, again, kind of a lunch meeting with the chancellor and ministers in preparation of the next report. So I think there is a usefulness to that, and it's different from many of the councils we have around the world, so I thought I'd share that with you. Throughout the year, we also give out reports, so special reports, articles. One thing we did this year, okay, I have still a little bit of time, was a special report on the Euro crisis, and I just want to say a few things here. A currency union of sovereign states. good idea or bad idea? Well, it has an advantage. One advantage is more deeply integrated goods and financial markets and lower transaction costs. That should, everyone, every member should get something out of that. It's hard to measure. There was another political reason why it happened in the multi-union in Europe, but that's one advantage. Another advantage, I think this disappeared from the picture in Anatol's talk, but back if you were reading things in the early 90s, there was an influential paper by Italian economists on tying your hands. So the idea was, we're going to tie our hands, we're going to give monetary policy away, and then the central bank will deliver low inflation, and we'll tie our hands. So that's how we get inflation down, by joining this union. But then you have to keep the hands tied, right? If you bring monetary policy back into fiscal policy, which what Anatol was proposing, that's going back. If you think that you're going to have, the central bank buying government debt forever and interest rates staying negative forever and inflation staying low forever, you might be in for a surprise. That's probably not going to last. That's the untying of the hands, anyway. But aside from that, let's go to the disadvantage. Monetary policy and the exchange rate are then not available as instruments for macroeconomic adjustment. That's a problem. And you can say there are alternatives. You can devalue by reducing wages or prices. That's hard because they're rigid. Can I have some water? Anyway, so that's hard. There are other adjustment mechanisms, labor mobility, so we observe that. And in Germany, there's massive immigration. I'm not talking about refugee migration. There's immigration into working, into jobs, primarily, however, from Eastern Europe. So it's not, thank you, thanks a lot. So it's not really working as an adjustment to the euro area crisis. There has been an increase in migration, but not on a big scale. It's mostly from outside the euro area. So fiscal policy is the main option. That means you have to let countries run their fiscal policy. That goes both ways. So if you need to help if you have a recession and you want to support the economy, you need to have more leeway on deficits. But also, say if output is growing above potential, if output is at potential, and if inflation is pretty close to target like this in Germany, then you'd have to have a fiscal policy oriented towards that in Germany. That's what you do if you give fiscal policy to the member states to do what they need in their country. Now, if you do that, liability and control needs to be unified. Right? So if you get the sovereignty over your fiscal policy, you need to remain, so if you're the control, you need to remain responsible and liable for it. Otherwise, it doesn't work. But as we saw, misaligned incentives and moral hazard contribute to a surge in private and public debt in the euro area to unsustainable levels. So if we want to think about solutions, I don't think we're there. So I don't agree with Anatol that that was the solution. That was, by the way, also not a big surprise, because already more than 15 years ago, we thought at the central banks about how to do QE when interest rates are at zero. So in a sense, it was not a surprise that central banks are doing that. But it's not to finance the government, it's to create some inflation. So the solution would be political union. That's a little bit like what Jörg Asmussen was talking about, right? He was moving a little bit in that direction. Sovereignty regarding, he wanted to give some more funding, I think, on the euro area level, some more sovereignty. I think that would work if really sovereignty regarding finances and budget is transferred to the supranational level. So liability and control on the supranational level. And I think in Germany you can find quite a good number of people who would support that. Now, but I think realistically, if you look around, this is not going to happen. And I think it's not because of the populism. But do you really think that a country such as France, the way it's organized, the way it's run, would really ever give massive sovereignty away? I don't think so. And I also had full understanding for the voters in Greece to say no, right? They felt, you know, we want to run things here. I can understand that. And I think that will prevent us from moving to political union. If you look around, there is no democratic support for that, even if you don't take into account the populism. So the strategy of saying, well, we know it's not going to work, but we keep hoping that the next crisis gives us another solution, and so on and so on. That's a very dangerous strategy, because of course the whole thing might unravel. And you know, if you throw in the populist vote to what's going on, then it's not so unrealistic. So I think it's not a good idea to just gamble for somehow getting there through crises. So what we thought is, maybe we need to go back to solution B. Solution B is, if you want to keep sovereignty on key decisions on the national level, you need to have a budget, right? No taxation without representation and all that. You need to have a budget. But then you need to be liable. And indeed, I agree with the statements. Just although there are improvements which have been done on the rules, on the compact, putting it in constitution and all that, but I think that's not going to do the trick. You do need market discipline if you really want to successfully strengthen no bailout. You need the no bailout if you want to keep the power, the sovereignty on the national level. And so we need to reform Maastricht. So I'm going to go a little. So we talked about the failures already. Let me show one chart. These are just the interest rates of long-term government debt, taking a bit of a longer perspective, right? So going back to the 80s, you see there were wide differences because there was a risk that, you know, even though you could always get your money back, the purchasing power of that money would have been much smaller because there was a lot of inflation. So in those countries where that risk existed, interest rates were much higher. Then interest rates came together, and then more recently they came apart, and then they came together again. But what's a big danger is to think of the period in between as the normal. Right? If that had been the normal, we probably stayed there. The period in between is where you see no differences. Can you see that? Right? So no difference. So there was no market discipline. Why wasn't it there? Well, markets just didn't understand. They're stupid. They're not reacting. That's one possibility. Right? But you know, on average, people are not stupid. You know, most people, they learn, and particularly if it affects them financially. So there are a few other options. One was, well, they had different incentives. For example, the ECB was accepting all the paper the same way as security. They're not doing that anymore. But of course, you run better with, you know, getting with Greek debt or with whatever Irish debt than, I don't know, Dutch debt, if the Dutch always pay, even if the risk is different. But if the ECB takes it just as well as collateral, then that's one thing. The other thing was banking regulation, right? In banking regulation, they're all risk-free. They're all treated as, you know, you don't need to hold capital against it. So we need to change some of that regulation. I'm going to close here 1 minute. So in a sense, Jörg Asmussen advertised it. He said, well, there are these guys who have Maastricht 0.2, but, you know, we're in this, you know, 0.12, yes, but it's the 2.0. I mean, you had 4.0, so we're a little slow. But the idea is let's redesign this so that liability and control are always unified. So there's some things you can put on the European level. We have multi-policy on the European level, so the central bank balance sheet is on the European level. By the way, much of the government debt remains on the local central bank's level, so balance sheet. That maybe I add that. But so we have a central bank balance sheet on the European level. So there's the risk of the banks is in there. So we need to also put banking supervision on the European level. So we were very supportive of that, and that means also, you know, bringing in no bailout in the banking system in the sense that there's a bail-in and that this is organized on the European level. So I think that was an important step. On the other side, on the left side, so on the fiscal side, if you want to keep the national sovereignty, you need also national responsibility. So you need to have the market discipline. In the middle, you basically have the crisis mechanism, and indeed, that's useful when you have a situation as we had, or it's important, where the fiscal room of the members, even if they follow the rules, like, you know, Spain and Ireland, they were actually quite exemplary. They had fairly low debt before the crisis. right? But it wasn't big enough to cover the risk from the private debt in the banking system, right? So, but still, they covered a good bit of it. So if it's not enough, you can go to the ESM. But in principle, in terms of stabilization over time, the idea is still not transfers on a contemporaneous level, but you borrow from the market, and if you can't borrow, maybe you get some guarantees or some support, some program against conditions. But so you can keep this as a country, you can keep the intertemporal option for stabilization. So there are a few missing items which we think in terms of the reforms which have done, they've mostly gone in the right direction. We don't think that you should go for transfers because it's not really solving the problem. What would solve the problem of ensuring the market discipline? There are two items. They're in there. One thing is here, state insolvency proceedings. Another one here is the abolition of regulatory privileges for sovereign debt. So I've summarized it here. In terms of the insolvency regime, I mean, you have to, before it's bailed out by the taxpayer of the euro area, you have to bail in the people who took the risks, right, and who went for the return. So you have to have an orderly regime for restructuring, and the other thing is you have to break the sovereign bank nexus. And what we need here is remove privileges of sovereigns in banking regulations. You might say, oh, we never get there. I'm not so pessimistic. I think we actually have a good chance of moving there. There are two things. We have a concrete proposal. It's gonna take me another 20 minutes. I mean, you're so committed, and I'm not gonna go through that. I'm not gonna through it. I'm at the end. But so anyway, if you're interested, there's a detailed proposal on that, and I think you have to give them risk weights. The Basel risk weights are already there for sovereigns. You just have to apply them. And you have to limit the overall exposure to your home country, right? So you have to get some risk sharing. So I'll stop here, and thank you for your attention.